So here is my Trading 212 Invest account, and if I scroll all the way down, you can see that I have one of my biggest holdings here, and in it I have 1,463 shares in the S&P 500 by iShares. Now if I switch to my Trading 212 ISA, you can see I also have just one holding, and this is in the same S&P 500 by iShares again, and here I have 5,021 shares basically in the S&P 500. So in total I have over 6,400 shares in the S&P 500. So in this video we're going to explore the best S&P 500 index fund to hold if you are a UK investor on Trading 212, everyone's favorite investing app. Now if you want to start your journey with investing and sign up to Trading 212, if you use the link in the description down below, when you sign up you'll receive a free share. If you've signed up recently and haven't received a free share, you can always use my promo code JUBAIR and you should receive a free share. So I commonly get the question, why on earth have I invested into the S&P 500 by iShares? And the fact of the matter is there are a lot of options when it comes to investing in the S&P 500 if you are UK or European based. Now the first thing that we want to do on our Trading 212 app is use the magnifying glass here. Once we get into it, we can use the search bar here and we can type in SP 500. Essentially that will list all the available index funds on Trading 212 if you want to get exposure to the S&P 500. Now if you're watching this video, you already know that the S&P 500 is the collection of the top 500-ish companies within the United States of America, which makes up for one of the biggest parts in the stock market globally as a whole. And it is very important because it is used as the benchmark for performance for every other stock essentially. So when we press SP 500, you can see there are a number of funds, and you will also notice that there are a number of different icons here. As you can see, there is a red box here with a V logo, and that is Vanguard. You also have iShares. So Vanguard and iShares together are by far the biggest players in the whole index funds mutual fund business. They control trillions and trillions of dollars in terms of assets. So assets under management, they control trillions of pounds. What that basically means is that they have the majority of the world's wealth basically in terms of private investors and retail investors like us. They will have some sort of exposure with Vanguard or iShares, which is owned by the BlackRock group. This means that they are very, very large companies, and it is more likely that these won't fail because of course the interest of them succeeding is basically with everyone, and therefore typically you'd hear go with Vanguard because they're more secure. It's because a lot more assets under management typically means there are a lot more people invested into it. There's a vested interest within those people to keep that money, so it's less likely that it's going to fail. With smaller companies, for example, anyone can really open ETFs. They have very small assets under their management. What that could mean is if the ETF fails, which it could do, the investors' money is at risk and things like that. So generally speaking, it is better to go with someone like Vanguard or iShares just based on how much they actually have under control. So the most popular S&P 500 will rise to the top on the search, and by far the most popular, not necessarily the best index fund, but the most popular is by far VUSA, which is by Vanguard. So when we go onto it, we can see that here we have the Vanguard S&P 500 and it says DIST, which means distributing, which means any income that is received through the index is paid out to the shareholders. So anyone who holds any shares in the company, the dividends are paid out instead of being reinvested automatically. For the most part, if you're investing outside of an ISA, oftentimes it is better to get the distributing version. Then it's easier to manage your dividend tax if you exceed those thresholds. However, one negative of getting your dividends paid out is that a lot of people will end up spending that dividend instead of reinvesting it. And if you don't reinvest your dividends, you're going to be putting a lot on the table in terms of future returns compared to someone who reinvests those dividends. So in any case, here is the Vanguard S&P 500, and you can see this is the price movement since around 2018. You might notice that it is slightly different from the profile that we see from the original S&P 500. So now what I mean by original S&P 500 is this here, the actual index. If we go on Google or anything like that, we can see, if we go to the last 5 years, we can see this is the profile of the original index. So this index is given in points. As you can see, currently it is 5,099. So this index follows the top 500-ish companies in the USA, and because it is the original index, it is not denominated in any sort of currency. It is not denominated in dollars, pounds, euros, or whatever. So whenever the value of these companies actually changes, the value of the points here, that number will change. So then it is up to fund managers like Vanguard to create their own index which mirrors this original S&P 500, but it is unfortunately impossible to mirror it one to one. This is because whenever you get currency involved, there are lots of fluctuations in the forex, so the foreign exchange markets, all the time. And also it is up to the fund manager to decide which way they want the index to mirror the original index. For example, it is up to the fund managers themselves what companies they want to exclude or include, how they want to run the benchmarks, how they want the currency situation to work out, whether they want it to be hedged, whether they are including certain companies or not including them. That will change everything on the index. So you're never going to get one fund provider that mirrors exactly with the S&P 500, especially as a UK investor. Once you factor in the pounds, that's game over. You could never one-on-one match yourself with the original index. And that is why we have so many different index funds for the S&P 500. So therefore, if you compare side by side the results between the Vanguard S&P 500 and the one you find on Google, you will find the profile is slightly different. Of course, this is denominated in pounds. As you can see, the price is given in pounds. So of course, there's going to be a lot of variance between the currencies of the pound and the dollar. Day to day, throughout year to year, there's huge fluctuations often. However, if you want to consider which index fund for the S&P 500 is best for you, there are a number of things that you have to consider. And the main thing I would say is probably the price, which is also known as the total expense ratio. Now, if you scroll down on this app, unfortunately Trading 212, they don't show all these metrics at a glance. If it's from Vanguard, they do for iShares for some reason. However, it is always useful to go into instrument details here, and you can actually download the key information document. However, before we click on the key information document, you can see that there are a few key information bits to take into consideration. So as you can see, every index fund or every stock has its own ticker code, usually 2 to 5 characters long, typically only 4 characters. So this is the VUSA, so the Vanguard USA. The full name is the Vanguard S&P 500 UCITS ETF. You don't really need to know what that means as a beginner. They're only trying to make it look more difficult to you so that they can sell you funds that underperform this stock. Most importantly, if you're in the UK, like most of my viewers, you would want this one because it's from the London Stock Exchange. There are some funds for the S&P 500 that are from Vanguard, however they're denominated in euros. You should not do this because if you get paid in pounds, you should only stick with your own currency to avoid paying that foreign exchange fee. And you can see here that this fund is denominated in pounds. Okay, so let's go into the key information document here. As you can see, when you do press it, you will get a PDF like this, and there is a lot of information here. The first bits will tell you what the fund is trying to achieve. For example, the VUSA, what it's trying to do is to try to track the S&P 500 passively. So passive funds, they cost less because there's no active fund manager. You're not paying anyone to make choices on the S&P 500. You're basically using computer algorithms or computer software to track the market in the way that Vanguard deems it wants to track the market. You can see that the index is comprised of large company stocks in the US, and the fund attempts to track the performance of the S&P 500 index by investing in all the constituent securities in the index in the same proportion as the original index. So basically it buys all the companies of the original index and then gives that performance back to its investors. So that's the most important part of this fund, is that it is trying to be a true representation of the original index given in pounds. So of course there's going to be a lot of fluctuations between the pound and the dollar, and that is not something they're hedging against in this particular ETF. You can see that the base currency of the fund is United States dollars, and then it's converted into pounds. So that will definitely be the cause for all the differences you see between that and the original index. In terms of risk profile, you can see that this is 6 out of 7, so actually pretty risky. As we know, investing in the stock market typically is always very risky short term. In the long term, 20 to 30 years, you can mitigate some of this risk by staying in the market for longer. Of course, one doesn't mean there's no risk involved either. Any sort of financial instrument, even technically putting your money in a bank, has a risk because anything can happen. So the most important piece of information are the ongoing charges. So for the Vanguard fund, this is only 0.07%, which is actually very, very low. Typically, you want something as low as possible because in the long run, if you're investing 20, 30 years, these fees really, really add up. If you have anything typically more than 0.3%, you want to avoid paying this because those fees are really going to add up. In the long run, if you have over $1 million in your portfolio, those fees could typically be in the thousands to 10,000s with a high ongoing charge. So by far, this is the most common UK-based index fund to track the S&P 500. However, if we go back, we can see the second most common is also by Vanguard, ticker code VUAG. So the difference between this and the VUSA that we just saw before is that it is accumulating. As you can see here, this one was DIST and this one's ACC. ACC stands for accumulating. So what this means is that it's pretty much exactly the same fund. However, this time instead of the dividends being paid out to the shareholders, instead it is automatically reinvested, reaccumulated, and therefore over the long term you don't have to worry about reinvesting those dividends automatically. In fact, it is more of a set and forget kind of investment, which is very popular for a lot of people who actually don't want to check their app every single month. What I would say is that if you're investing outside of an ISA and you have lots of these funds, you are still liable to be paying dividend tax. So then it becomes more difficult to pay those taxes because you don't really know what dividends you were paid when. As you can see, the instrument details, this has the ticker code VUAG, so same full name and things like that. So if you go into the key information PDF, we can scroll down and we can confirm that it has the same exact total expense ratio at only 0.07%. So although these two are the most common S&P 500 funds, it doesn't mean that it is the best. It is only you that can decide which one you want to go for. For example, this does track the index very similarly to the original index. However, of course, because of the difference between the pound and the dollar, there's going to be some fluctuations there, meaning sometimes you'll get less returns and sometimes you'll get more returns. So the next fund we're going to look at is from iShares, and this is the iShares Core S&P 500 accumulating version, ticker code SXR8. So immediately the first thing that we see is that this is actually denominated in euros. So if you're based in the UK, I would not recommend this because you're going to have to pay foreign exchange fees on top. Trading 212 has a foreign exchange fee of 0.15%, so I would not recommend that if you don't get paid in euros. But in either case, you can see that the value of this fund compared to the previous ones is very, very high. And this has nothing to do with how much future return you'll get because everything is percentage based. They will still move in the same percentage ways as the other funds, relatively speaking. So just because it has a higher value now doesn't mean anything. It could just mean that it has been around for a longer time or the fund reaccumulated things differently. So with iShares funds, you can see a lot more details. So for example, the SXR8 seeks to track the performance of the S&P 500. You can see that it also has a total expense ratio of only 0.07%. And if we scroll down, we can see it has 509 holdings. One thing to note is that because this fund has a much higher value, unless you have around 500 euros, you're not going to get a full share. So sometimes it is better to go with funds that have a lower value because you can pick up more shares. Although ultimately your percentage gain is not going to be any difference in terms of if you earn 10% more. If you make 10% gain, you're making 10% gain regardless of how many shares you have. But if you like the peace of mind of having less fractional shares, then of course go with a fund that has a smaller amount. So the next S&P 500 fund we're going to look at is the iShares S&P 500 Information Technology Sector, which is also an accumulating fund. So this is the first one that is going to be a little different. As you can see, the price is in pounds, is actually in pence. So as you can see, this has a ticker code IITU, and if we scroll down, we can see that this fund tracks the performance of the S&P 500, but it focuses on the information technology sector. The expense ratio is currently 0.15%, which is roughly double what we've seen before. The assets under management is currently £4 billion, which is quite sizable, but not the biggest. And you can also see the average annual return. So over the past year, the information sector has returned 39%, which is absolutely staggering. You can also see that it has only 69 holdings instead of the whole 500. And this is because these are only technology companies. You can see by size, they have almost 25% invested in Apple, 18% in Microsoft, 11% in Nvidia. This means that there is a lot less diversification in this fund, so only 69 holdings versus around 508. This also means that if these companies do well, your portfolio will be a lot higher compared to the S&P 500. However, when these companies don't do so well, your portfolio will be a lot lower than the S&P 500, meaning that this is not a true representation of the S&P 500. However, that being said, because these technology companies have done really well, you can see that over the past year, this has yielded 145% return. Over the past year, a 43% gain, so absolutely staggering. But as we know, past performance is no indication for future performance. And by exposing ourselves to that sort of lack of diversity, we can put ourselves at extra risk. So the next fund we're going to look at is the Vanguard S&P 500 accumulating, but this is a ticker code VUAA. You can see that this is actually denoted in dollars. So again, if you're from the UK, you wouldn't go into this. You can see that the profile is looking very similar to the original S&P 500. And the cost of this fund again is 0.07%. However, as a UK investor, I would not recommend this because it's denominated in dollars. We also have the iShares S&P 500 Information Technology Sector Accumulating Fund here, QDVE. If we go into it, we can immediately see that this is denominated in euros and the total expense ratio is 0.15%. So next we can look at the iShares Core S&P 500 Accumulating, ticker code CSPX, and you can see this is denominated in dollars, so again, can't recommend this, but the expense ratio is only 0.07%. Assets under management here are $70 billion. We can see here we have the Vanguard S&P 500 VUAA. If we go into it again, we can immediately see that this is euros. So it's very important to go into the fund, see if it's denominated in pounds, and then figure out what the fund offers. So again, as a UK investor, you won't go into this fund here. So here we have another player here. We have the Invesco fund, and this is the Invesco S&P 500 accumulating version. Is actually denominated in pounds. As you can see, the price is actually pretty high. This has the ticker code SPXP, and again here you can see it is denominated in Great British pounds. If we look at the key investor information pack, we can see that it has an ongoing charge of only 0.05%, which is very low, much lower than Vanguard actually. However, the fund is a bit different. Like I said, every fund manager has their own decisions as to what to put in their S&P 500 fund. So of course this fund is passive. However, to achieve this objective, the fund will use unfunded swaps, and essentially you don't need to know what swaps are, but this is different from the Vanguard fund. So there will be slight differences in the performance of the fund compared to Vanguard and compared to the original index. We also have the iShares S&P 500 here, IUSA, and as you can see, this is also denominated in Great British pounds. You can see currently their total expense ratio is only 0.07%, which matches with the S&P 500 by Vanguard. Current assets under management are around £12 billion. There's also, you can see dividend yields. So all of these S&P 500 funds do have slightly different dividend yields. However, I wouldn't base my purchasing decision just on dividend yield, as that can always change based on the price of the share, and because all of the S&P 500 funds don't really have a high enough dividend yield to actually matter in my opinion. You can also see here they have around 508 companies that they invested into, and if you are looking for an S&P 500 fund, you can go with Vanguard or you can go with iShares. They're pretty much going to be very similar stuff. Of course, the differences between the funds are going to be the little small choices they make in deciding how to passively track the index. We also have another player called Invesco, and we have here the Invesco S&P 500 high dividend, low volatility distributing fund. We can see over the past year, this fund has only gained us 2.68%, which is actually very poorly performing. If we scroll down into more details, we can see that this fund has the ticker code HDLG, and in the key information document, we can firstly see that this has a much higher ongoing charge of 0.3%. And the objective of this fund is to generate income and capital growth while trying to be low volatility and high dividend. So although maybe the fund has performed very badly compared to the original index, you can see that going on Hargreaves Lansdown, obviously because I'm not sponsored, I can just show whatever I want. You can see that the dividend yield is 4%, which is a lot higher than the typical 1.1 to 1.4% that you'll see with all the other fund providers for the S&P 500. So if you really want low volatility but high dividend yield, you might want to see this fund. However, we can see from the profile there's no such thing as low volatility, because although they try to reduce volatility, we can see that since 2022 the fund is down a whole heap. So essentially what you'll find is that there is a near limitless amount of options when you want to invest into the S&P 500. So as you can see, I can keep scrolling down through this whole video and going through different niche ones. For example, the Wisdom Tree S&P 500 3x leverage, which of course uses leverage, which I won't get into because the price might go up 3 times, but it also might go down 3 times, which means very high volatility. There's one that I'm going to show you that I personally always invest in, and that has the ticker code GSPX, as I showed in the beginning. Now, I am not saying at all that you should choose this fund because I choose it. I choose it because I like it for a few reasons. The first reason is the fact that its value is very, very low, which means that I can grab a lot of shares. And for me, it is easier to know that per share, if the value of this share goes up by 1p, per share I hold, that will also go up by 1p. If I have 6,000 holdings, for example, per 1p this goes up, I will go up around £60. So for me, mentally, it's very easy to gauge how much I can gain if it goes up or down. Secondly, the main reason I use this fund is because it is hedged. So as you can see, this fund tracks the S&P 500. Of course, as usual, you can see that its expense ratio is at 0.1%, which is 30% higher than the Vanguard or another S&P 500 fund from iShares. Current assets under management is 70 billion, which is quite decently sized. You can see currently it has a pretty low end dividend rate of only 1.16%, something I do not worry about ever. You can see again, it has around 509 holdings, very similar to everything else. If I go into instrument details, you can see the ticker code is GSPX, London Stock Exchange, and Great British Pounds here. If I go into the key information document, you can see again ongoing charges is 0.1%. However, the difference in this fund is of course that this fund is hedged. So if we scroll down to the information, you can see that your shares will be hedged with the aim of reducing the effect of exchange rate fluctuations between their denominated currency and the fund's underlying portfolio. The fund's underlying portfolio is in dollars and the denominated currency is Great British Pounds, of course, pound sterling in other terms. For me personally, I found that the changes in the fund reflect closer to the original S&P 500 because of this hedged version. Although you're paying 30% more, I would rather get what the Americans are getting back home in my own money, and then to see if there's any difference in the original fund, it will reflect back on this fund on a more one-to-one basis, although that is almost impossible to pull off. I would love to know what S&P 500 fund is the best for you or the one that you're investing in, and make sure to check out some of my other videos, and I will see you in the next video.